Good morning, option strat traders. Steve Gans of SJG Trades here to share another concept idea with you. This is actually a build out of the trade that we entered. I think it was on Monday is when we entered the first leg of this trade. Then we added to this trade on Tuesday. Now, this is going to be what I called our SPY long put trade. So let's just take a look at this. So initially on Monday, as you may recall, I was looking at a chart of our market here. Let's just go take a look at the chart in SPY in this particular case. That stars as an earnings trade I did yesterday. But let's look at SPY. Let's go to daily bars because that's what I was looking at the time. And I had said when we were bumping our heads on this down trend line that we may get a reversal here. So I was buying a long put. Again, everything I recommend is paper trading for learning purposes. So we bought a long put, just the lone long put. And then as the market started to sell off the next day and this trade came into a little bit of profitability, I said, well, let's sell a short put against that. So again, just to kind of show us the impact of that, if you go back and look at that trade, and I would urge you to watch that because it kind of lays out our game plan. At the time we entered that, this trade had $704 in risk, which was essentially the $7.04 that we spent on this long put. Then a couple days later, when this trade went in our favor, I showed, well, let's sell a $400 put against this long put. And we took in some money for doing that, and that greatly reduced our downside risk. That reduced, I say downside, actually if the market goes up, it reduces our risk in the trade significantly. So rather than $700 in risk, we're at about $230 in risk. And that's because we took in the roughly $500 when we sold this. Now this trade has continued to move into our favor profitability-wise. This trade is now up $146. Now, I had mentioned in the prior video yet another move that could be made in a trade like this. This is called layering in to a trade. Our thesis is playing out. Our thesis that the market was going to go down is playing out in our favor. So let me show you yet another thing we could do, and that is turn this into an all-put condor. So this is a little different than an iron condor because we're using all puts in this case. But to do that, we would come down in here somewhere. Our market's currently at 406, so you could decide, where you think the market might go. I'm gonna stick fairly tight here. I'm gonna maybe do 395. So I can come in, I can add selling a 395 put. That would then raise this right wing to where we would have no risk to the upside. In this particular case, we are essentially guaranteed a no-lose trade if the market continues higher or just doesn't go below 385. However, right now, because we just sold this 395 short put, we do have unlimited risk to the downside because we have this naked put in there right now, this naked short put. So it's very important, again, the way I recommend people trade, particularly new traders, always make sure you have defined risk. So we want to define our risk so that we're not taking exorbitant risk to this side. So to define that risk, we need to now come and buy a long put at a lower price yet. So let's go ahead. We're going to buy a put now. And let's move this put down to a point that we would like that to be. And we can decide, where we want this to be. We can make that, a very tight spread. Here we've got a 10-point spread on this side. So if we turn this into a 10-point spread on this side, 395 to 385, that's what this trade would look like at that point. And at that point, we have very little risk in this trade. Our maximum loss on this trade, no matter what the market would do at this point, if the market were to rip up 100 points, we would lose $43. If the market were to rip down 1,000 points, we would lose $43. Well, how might we be able to make this trade a no-lose trade at this point? Well, one thing we could do is rather than selling this put at 395, we could sell this put at 400, the same place we have this other put sold. We can still make this a 10-point wide spread. So now we have converted this, rather than being a put condor, this is now what's called a put butterfly. So the only difference between a butterfly and a condor, and this confuses a lot of people, the only difference is that in a condor, those center strikes are split apart. In a butterfly, those center strikes will essentially be right on top of each other. So that's really the only difference. So right now, if we were to take this trade and we were to do this, for example, we were to sell a 400 put, buy a 390 put, if we stay under this tent, this will be a nicely profitable trade in this particular case. And we have no risk in this trade, no risk of loss in this trade anymore. Now, we could give back some of our profit. This trade is actually, the market must have just moved south on us. Yeah, it did move south a fair amount. Big move in the ES futures here. So that gives us even a better price on this put spread we're going to sell. And that's what now has turned our profit to $251 and allows us to sell this even for a higher amount yet. So right now, if we get into this trade and we were to sell the other half of this, again, this is the ideal situation for an options trader. We have now a no-lose trade. The worst case scenario in this trade is we have $104 in profit. The best case scenario in this trade is maybe we take it out somewhere up in here for $500-$600 in profit, somewhere in that general range. So every trader can make that decision for themselves. And to see kind of what's happening there, if, again, this is our curve at expiration, but let's just see what this might look like here in a few days or April 16th, somewhere in that range. If our market stays in this general range on April 16th, we should have about $280 in profit if we head on this full trade. As, of course, time goes on, that line curves up higher and higher, and eventually it will meet our line at expiration. So at some point, it becomes all about, for the trader, how much is enough? At what point do you say, you know what, I'm good with capturing my 50%, 70% return, and you exit the trade. But right now, the takeaway that I wanted to share with you is that we had a trade that started, let me just, again, and if you get this already, you don't need to watch this last part, but I just want to kind of reiterate how we got into this. So we started by just buying this long put. That was it. When the market went in our favor a little bit, we sold a put against it. That gave us this type of position right here. This position is currently up $237 now. And our risk, if we sold that today, our risk would only be $141. Now we want to layer in yet another part of this trade. We want to layer in this spread. If our premise is that the market's going down and it's going down hard, maybe we don't change anything about this trade. We just wait for it to come down in here somewhere. But if our premise is that, you know what, I don't think the market's going to go much below 400 or much below 395, that's when you would come back in and say, okay, well, I'm now going to sell a 400 put and I'll buy a 390 put to add protection. Then we end up in this scenario. Now our max gain has gone significantly higher because of the additional premium we took in to sell this extra spread. So the goal here is I wanted to be able to have traders see how a trade can be phased into over time. Again, this is a paper trade, a practice trade. I urge all of you to experiment with this on your trades. Most options traders do not put on a trade and then just take that exact same trade off. Most options traders will adjust their trade during its life, and doing things that will allow you to bring in more premium or ideally get it worked into a no-lose sort of trade like what this one would be. So hopefully that was helpful, and everyone have a great long weekend this weekend. Take care.